Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Kirk Chisholm. He is a principal and wealth manager at Innovative Advisory Group, which is based in Lexington, Massachusetts. He is an expert on self-directed IRAs and also alternative investments. Welcome to the Money Answer Show, Kirk.
Hey, thanks for having me on, Jordan.
Just give us your history a little bit and how you got to where you are today.
Yeah, sure. No, I think that would be helpful. Yeah, I started in the industry in December of 99. So I think if anybody here remembers, they can probably remember that was the peak of the market. And I learned risk management really quickly because the market pretty much went straight down for a few years. So after working in the wirehouse channel, I actually went over to an independent broker-dealer and then ended up starting this firm about 12 years ago because primarily what we're looking for is we're looking to really find the best way to invest for people. And, you know, sometimes that includes things outside of the stock market. So that's really kind of why we started this firm. And really as kind of experts in self-directed IRAs and alternatives, we just find that there's a lot more interesting investments there than just in the stock market. So
tell us what you do for your clients at Innovative Wealth.
Yeah, so we're fiduciaries. We're wealth managers, so we manage their portfolio. You know, we provide financial planning. Really just kind of the way we look at it is we provide oversight and guidance for anything that affects their life financially. You know, but we just are not restricted by just the stock market, you know, stocks, bonds, and mutual funds, things like that. So really we kind of take a holistic look for our clients and really try to figure out what makes the most sense for them.
So you become an expert in self-directed IRAs. We're going to get into the details of them, but in general, why should people open a self-directed IRA instead of a traditional IRA, which doesn't have as many investment choices?
Yeah, that's a good question. And I'll say that one of the common misperceptions is that self-directed IRAs are different. And actually, self-directed IRAs are the same as a regular IRA. The IRS code is actually no different, or the Internal Revenue Code is really no different. Every IRA is self-directed. What is different is actually the custodian. So if you go to your TD, Schwab, Fidelities of the world, and you say, "Hey, I want to invest in a horse in my IRA," they'll look at you funny because they don't provide that, and they probably couldn't do that if you asked them to. I think if you had enough money, they might try, but really they don't specialize in that. They're really good at the traditional investments. Now, there are other custodians that specialize in alternative investments. There's really no difference. They can also provide traditional investments, but they've decided to specialize in alternatives. So really the difference is the custodian that you use, because the assets are allowed in any IRA that you can hold. There are really only certain assets that you can't hold. Otherwise, you can pretty much invest in anything in any IRA.
Why don't the traditional custodians like a Vanguard or Fidelity or Schwab have a separate division that does alternative assets as well in self-directed IRAs?
Well, that's a good question, too. I'm going to speculate because I can't read their mind, but I would imagine that it has something to do with profitability and specialization. So I know that if you have enough money, you probably have like 9 figures, I'm sure you could get them to maybe try it. And I believe that there are some parts of those divisions where it's possible in some ways, but not in all ways. I think part of it's specialization. The other part of it, too, is in any given year, there's between 4 and 6% of IRA assets are actually held in alternatives. So it's actually a very small market for them. When you think about the trillions of dollars that are held in retirement accounts and how much of that is in stocks, bonds, and mutual funds versus alternatives, there's probably a good reason why they don't specialize. And if you want to understand why people don't, I'd say maybe 10% or less of the population is even aware this is possible. And one of the reasons is because the big firms advertise. You know, the big wirehouses of the industry, they advertise, and they're not going to advertise something that they don't do. And these other firms that specialize in alternatives, they don't advertise, or they do advertise, but not as much. You probably have never heard of this. So in many ways, that's really what it comes down to. There's nothing nefarious. It's just they're promoting their own interests, and that's what people have gravitated towards.
From a portfolio diversification point of view, what kind of extra return can you get, and how does it affect your risk profile if you have some portion, 10% or so, say, in alternatives versus just only having traditional stocks, bonds, and funds?
Yeah, so I think there's a lot of common misperceptions around this. So the industry itself has taught us all for decades that it's really important to diversify to reduce your risk, and I would agree with that. I think that sentiment is valid. However, if you really dig into the details of that, what they really say is that diversification with a portfolio of low to non or even inverse correlated assets is what will help you have a lower risk portfolio with a smoother ride. That's really what they've said. The problem is since I'd say the mid 2000s, the correlations in the markets have actually gone close to each other. So back in 2001, I read an article about Timberland. Timberland is something that for the last 15 years, institutions have been trying to get access to because it had as close to zero correlation to the public markets as anything I've seen. That was back in 2001. If you look at it now, it has a pretty close correlation to the S&P. Why? Well, that's a good question because we actually did some research in 2006, 7, and 8 with a lot of these alternatives. And what we found out was when they're not owned by institutions, they're low correlation. As soon as the institutions start acquiring them, they tend to correlate them. So that is my suspicion based on looking at a bunch of alternatives. As soon as the institutions buy them, they become correlated, which means they're losing their advantage of being alternatives. So go ahead.
I don't understand why that would be. Just because institutions own them, why would that mean Timberland would track the performance of the S&P 500 just because the ownership has changed from individuals to institutions?
Well, good question. So if you think about real estate in the early to mid 2000s became more widely owned for obvious reasons. Everybody thought real estate's going up forever and never goes down. And if you look at some of the big pension funds, some of the big institutions, they started increasing their real estate exposure. And what happened after that, real estate dropped, and then a number of these pension funds and institutions end up selling their real estate. Well, think of let's remove the alternative piece for a moment. Let's just look at a stock, right? Let's say one of the big FANG stocks, and for compliance reasons, I can't probably name names, but
fine.
Let's just say one of the big FANG stocks, and you probably all know what they are.
Yep.
Let's say those are stable. Let's say it's a good company, it's well run, nobody's arguing that. Well, when the stock market starts to sell off, when you start to have what I call contagion, take the oil markets back in 2015, 16, when we're arguing with Russia and that whole thing. Well, when oil prices started to collapse, what happened is oil prices started to collapse, then these oil company equity prices started to collapse, then their bonds started to collapse. Everything started to correlate when there's a sell-off. This didn't used to happen decades ago, but it happens a lot now. So what happens is people realize they have to sell their oil stocks. Well, okay, they can't really sell their oil stocks because they've already declined a significant amount. So let's find something else I can sell instead. Oh, well, let's take one of these FANG stocks. They're still doing well. Let me sell off some of that. Well, that starts to pull down the price of those stocks. And then they go to other things. So I call it a contagion effect because it starts in one area and then it spreads out slowly to other assets because it's not because they want to sell those assets. It's because they have no other choice. They need liquidity. They need cash. In order to do that, they sell anything that's liquid. And high yield bonds, if anyone remembers back then, they were frozen. Right. 3 days in a row, 3 separate funds froze up. So you can't sell that, so you have to sell something else. So that's why they correlate, is because they become institutionally owned, and if they have to sell something, they sell whatever they can.
We're going to go into some of the alternative investments later, but are you saying in general, for individuals, it would be better to buy some of the alternatives that are not that heavily owned by institutions at this point to not get that correlation effect?
If you're looking to get a portfolio with low correlation and well diversified, that would be ideal. The problem is it's really hard to find those nowadays. So you really just have to understand what you're owning. And quite frankly, some of the best assets that I've seen are assets that people know best. And as we get into this, I'll talk a little bit about it. But The ones that tend to correlate are things that are put into funds as opposed to individually owned. But the ones individually owned tend to correlate a little bit less.
Is there some way of finding out what percentage of institutional ownership there is in the various alternatives?
There is, but it's going to require a lot of effort. I mean, it took me a lot of effort just to acquire institutional data on Timberland, managed futures. You got private equity, you got hedge funds, you have a lot of these quote unquote alternative assets that people are gravitating towards. You can find it, but it just takes a little bit of effort to see, how much of it's owned. We did a study. It took us a few months, but it was worth it.
It's not something the average person could really do then, you're saying?
They can, but it's probably going to be a lot of work for them. I would say, we can talk a little bit more about this after the break, but I would say the way I would look at it is, if somebody's making a good amount of money investing in horses, that doesn't mean you should. You should find something you know well. If you know horses well, you shouldn't invest in diamond mines. You got to find an asset that you know well and invest there. That, from my standpoint, is what people tend to find the most successful investments are that.
So using your own knowledge and familiarity will help you do well at a particular investment.
Yeah, I mean, Peter Lynch said it. Invest when you know.
Exactly. Very good. Okay, we're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Kirk Chisholm. He's a well-known pioneer in the wealth management industry. He's an expert on self-directed IRAs and alternative investments. You can find out more about him and his work at innovativewealth.com.
Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Kirk Chisholm. He's a principal and wealth manager at Innovative Advisory Group based in Lexington, Massachusetts. He is an expert on self-directed IRAs and alternative investments. Welcome back to the show, Kirk.
Hey, thanks for having me back, Jordan.
So you have a quick start guide to self-directed IRAs, and in there you have what you call the Self-Directed IRA Roadmap. So let's just kind of briefly go through how that works so people can understand what it takes to open a self-directed IRA. The first one is just to learn the terminology of it. So what are some of the terms people need to know about self-directed IRAs that are unusual?
Yeah, so there's a lot of terms in there, and I think this is where a lot of people get confused. So there's terms like the term self-directed IRA and what it actually means. A prohibited transaction, that would be probably the one thing that everybody needs to understand. I can go into that a little bit, but basically what a prohibited transaction is it's something that you do that causes your IRA to effectively be invalidated or to distribute the assets. So let's say you had like $100,000 in your IRA and you invested in a piece of real estate, and then you decided to live in that real estate. That is a prohibited transaction, and that would require you to distribute all $100,000 of your IRA in the year that it's that it caused the transaction. Now, I would say that one thing that's interesting is it's not that the prohibited transactions aren't a problem in themselves and that they happen. That's a problem in of itself. The big problem is, let's say you do that. Let's say you live in it for a year, and then 6 years later the IRS finds out. Well, it's not just that you have to take a distribution. It's you have to take a distribution plus you have the penalties and interest for 6 years. You do that long enough and you may have nothing left out of that 100,000. That's one of the problems. Okay. So disqualified person is another one. That's a person that you can't do business with. So for instance, let's say you are a disqualified person inside of your own IRA, so you can't do business with yourself. You can't do business with your spouse, your kids, your grandkids, parents, grandparents. Those are disqualified people.
It has to be an arm's length transaction, basically, you're saying, right?
Correct, right. Arm's length. You have to treat the other person or party as if you didn't know them at all. Like that's kind of the qualifications you have to consider with the other person.
The second part of your roadmap is to choose an investment strategy. Mm-hmm. So there are many different ones. So how do people choose? We talked before about being familiar with it yourself, but how does one choose amongst all these different options where to put your money?
Yeah, and I think one of the dangers that most people have is they hear about something and they get all excited because they hear, ooh, you can make 20% returns, or my brother-in-law did this and they make lots of money. And they immediately just say, I'm going to do that. And I see this a lot. It's funny. I had I had somebody on my show a while back, and they said, "Oh yeah, we can get like 20% returns from this type of investment," and the person got like just bombarded with listeners calling in and say, "Oh, how do I find out more about this? How do I do this?" And it's like, it's not the performance that matters. It's how you manage the risk and understanding it. And a lot of these people had no idea what they were doing. So what I find is most appropriate is if people invest in what they know. So if you have an understanding of real estate or private company stock or widgets, or medical device equipment, tax liens, whatever it is, if you don't have one of those areas that you know really well, try to do your research on one. Just figure one out, figure one that seems exciting or interesting to you, and just start digging in and doing the research. Don't focus on the performance first. The way that we look at investing is we have this philosophy of risk management first. Because if you do the risk management first, the performance is the easy part. Because that takes care of itself. But if you don't take care of the risk management, you can end up losing a lot of money, and then the performance is kind of irrelevant at that point.
Your third step is to choose a custodian or administrator. So there are quite a few out there in the self-directed space. What do you look for in a good custodian or administrator?
Yeah, so the concept of custodian versus administrator is really important. And I think there are a lot of companies out there that are promoting the idea that you should have a self-directed IRA. Many of them are what I call investment sponsors, or they're sponsoring an investment. They're saying, "Oh, I have this fund, and you should invest in it. Oh, by the way, you can use your retirement account, and I'll help you set it up." Well, what is a requirement is that you use a qualified custodian. So you cannot put your IRA money in your desk drawer, right? It has to be held at a qualified custodian. And what is missed for a lot of people is they miss that step, and sometimes they end up creating a prohibited transaction because the money is not held in the right place. So it is required to use a custodian. Now, administrators are another piece of this. Now, the regulatory environment has caused a lot of them to convert to custodians in the last few years. But what a lot of the administrators will do is they will help facilitate the transaction, and they will use a custodian or a bank. And I think depending on how they do it, that can create some problems. But that's something that you should research. We have a big list of over 45 custodians administrators that you can research yourself. There are a lot of them out there. Some are better than others, but it's really important to do your homework when you choose the one you want to use.
Is fees a big differential between the different custodians, or are they pretty much the same?
What's interesting about custodians and administrators is that every single one of them is different. Now, if you look at like the traditional custodians, like the Schwabs, the Fidelities, the TDs, if you look at those, they're pretty much all the same, right? The trading costs are zero now. And when one went down, they all went down. So when you look at it from that perspective, they tend to mirror each other. But with the self-directed space, they're all different, which is really weird because you'd think that they'd all gravitate towards the best practice and they'd all compete. The problem is some of them specialize in real estate, some of them specialize in private companies, single or multi-member LLCs, and the fee structures vary too. Some of them are transaction-based, some of them are based on assets that you have, and some are a hybrid. And you might think, well, why would anybody pay one versus the other? Well, a lot of this comes down to the type of transactions you're doing. So if you think of it this way, let's say you're going to buy a business, and you're going to buy that business and hold it for the next 20 years. Well, a transactional-based custodian might be the best choice for you because that may end up being the lowest fee for you. But if you're doing, like 50 transactions in a month, an asset-based custodian might be best because that might be the most cost-effective. So, it's not as simple as just a transaction as buying a stock. We actually have created calculators for all these things because it is so complex in how they do their calculations. And
you have all these things at innovativewealth.com, is that right?
Yeah, we'll give you a list on the show that people can kind of can link to get access to these reports. But yeah, you can go to innovativewealth.com and look them up, and then there's further resources for people who really want to dig in.
Great. Then the fourth step is to open your account and fund it. I guess a lot of people open accounts but never fund it. Is that right?
You'd think that's should be more obvious, but yeah, that actually happens a lot. So what'll frequently happen is people will open up an account. They'll get they'll get a teaser, they'll go to some seminar, and there'll be some teaser, oh, I should invest in this. They go through all the efforts to open up an account, and they fund it or don't fund it. Either way, they're still paying for the account once it's open. It's not like a brokerage account where you don't pay a fee for keeping it open. These accounts, they actually pay, they charge you to open it, and they charge you quarterly or whatever their fee schedule is. And so one of the problems is people, they open it and then they just get stuck because there's this process of actually having to have an investment. Yes. Which is very intimidating to people, right? It's not a simple process. And once they open it, they realize, like, I don't know what I'm going to invest in. And then they get overwhelmed and they shut down, and then they just go on to the next thing. So it's really important to actually fund it. So there's a large percentage.
Your fifth step is to actually decide an investment and complete the transaction, which again sounds like something some people don't do, even though they've got money loaded up in this thing.
Yeah, correct. So you have to find an investment and finalize it. So going and doing your due diligence, making sure it's a good fit. And, you know, if you look at the best venture capitalists out there, they might pick 1 in 20 out of all of the investments they look at. They might, you know, get rid of 19 of them and just take one. So don't be afraid to just cut them off and just say, you know what, this isn't a good fit for me. I'm moving on. Make sure that you feel comfortable with it and you've done enough homework so you feel good about the investment.
And then your sixth and final step in the IRA, self-directed IRA roadmap is to monitor investments. So how do you do that?
Yeah, so the monitoring is also important. So what ends up happening is there's I shouldn't say there's a lot of, but every once in a while there are fraudsters out there, and they target, you know, self-directed IRA investors because the money is basically sitting in their retirement account for like 20 years. And so it's really important to monitor your investment once you actually invest in it. You want to keep up with the investment. If it's real estate, most likely you're going to be actively invested in it. You know, I don't like the idea of being a passive investor. I think that's kind of a false narrative. But let's just say you're investing in a company. Keep up with the company, talk to the owners quarterly, get their annual reports, see what's going on. But do that monitoring and making sure that the company is doing what they say they're going to do. Also, you have to consider the fact that, you know, there are things you have to do every year with your self-directed IRA to make sure that you're staying compliant. And I think a lot of people forget about that they just think you can just set it and forget it, and that's not always the case. So you have to make sure you're able to monitor that and make sure it's in compliance as well.
What do you need to do every year to maintain it?
It depends on the investment, but one of the big things is doing annual valuations. So every investment needs to be valued at minimum one time a year. And it can't be this flimsy thing. It has to be an actual valuation.
Even if it's illiquid and you can't find, a horse or something, how can you're not an expert in valuing these things. You have to get an expert appraisal?
There's a lot of nuance there, but I'll say that the simple answer is you do need to get a qualified appraisal. So you need to come up with something that is legitimate in that industry, and it varies per asset. So there's a lot of variability there.
Very good. We're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Kirk Chisholm. He's a principal and wealth manager at Innovative Advisory Group based in Lexington, Massachusetts. You can find out more about him and his firm at innovativewealth.com. We'll be back after this. Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Kirk Chisholm, Principal and Wealth Manager at Innovative Advisory Group, based in Lexington, Massachusetts. His website is innovativewealth.com. Welcome back to the show, Kirk.
How's it going, Jordan?
So you have a long list of alternative investments, and we just want to get a sense of these things and why it makes sense as an alternative for traditional investments inside a self-directed IRA. The first one is probably one of the most popular, is residential real estate. So what are the pros and cons of doing residential real estate in a self-directed IRA?
Yeah, so, residential real estate is something that we all know. If you don't own a property, you probably rent a property. Everybody has to live somewhere. So residential real estate is something that we're always going to have a need for. As long as there are people in this country, there's going to be a need for residential real estate. Now, one of the benefits of real estate is the use of leverage. So it's one of the few assets out there that you can use leverage, and it's reinforced by the system by the banks, and the government is trying to incentivize people to invest in real estate through the tax treatment that they get. So we find residential real estate to be a really good investment, but you obviously got to do your research and come up with the right property at the right price, and also you have to find tenants. I will say one thing, a lot of people think of real estate as passive. I would actually not use that lens to describe real estate, because if you look at it as passive, you'll probably be disappointed. You have to look at it like an active business if you really want to be successful.
How do you get a mortgage on a property inside a self-directed IRA?
Not everybody uses a mortgage, but if you do have a mortgage on a property, there are banks that will lend off of that. I think there are 3 banks out there that will lend. You can also go to the private market. If anybody's been following the lending market, you realize that it's been tightening up pretty much since 2008. And each year it gets harder and harder to borrow. And at some point, one of the mortgage brokers I talked to said, at some point, if you're a business owner, you probably won't get a mortgage at all. That's how kind of silly it is. So the private market is going to start expanding, and there's plenty of money out there, people looking to lend. So, and you have a lot of these crowdfunding sites. You got hard money lenders. There's always access to capital. It's just what price you're going to pay for it.
But typically, the average person buying a home or property all cash is the easiest thing to do inside a self-directed IRA, and then the rental income you get just keeps compounding inside that IRA. You can invest it in other things. Is that right? Yeah,
that's correct. I mean, if you're paying all cash, you're creating more cash flow. You don't get the benefits of leverage, so your returns might be a little bit lower. Depends on what the numbers look like. But I think just like anything else, whether you use this inside of an IRA or out, you still have to run the numbers to see whether it makes sense to use a mortgage.
Yeah. The next one is commercial real estate. Now, particularly in the current environment where people aren't going to work and a lot of retail stores are closing, has that changed the attractiveness of commercial real estate?
It depends on your perspective. I would say right now commercial real estate is probably not the best place to be. I know a lot of people who work at some of the big commercial real estate research firms, and the trends are pretty obvious. They're going against commercial real estate. So I would not be an owner of commercial real estate at this point. I think there will be a time to invest in it. And my whole philosophy is, because I think a lot of people look at assets and they say, oh, that's a good asset or that's a bad asset. There are no good or bad assets. There are only good or bad prices. So if you look at commercial real estate, you might say, well, it's trending down. People don't want, to rent office space. Well, if you get it the right price, it's going to be worth it. You just have to be patient and find something that makes sense for you, because there will still be people who need commercial real estate.
Prices have come down, but you don't think they've come down enough to make it compelling, is what you're saying?
Not for me. No, I don't think it's. I don't. The problem I see with commercial real estate is the trend is away from commercial real estate, but we don't know where that trend stops, because what COVID has done is basically accelerated every single trend that was already in existence. It just accelerated it quite a bit. So if you kind of look forward and say, what's going to happen from here? Well, there are still going to be companies that still need office space. There just won't be as many of them. So maybe we've overbuilt commercial office space. We don't know. And I think we're going to find out. And I don't need to pick the bottom. I would just rather pick it when it's on the uptrend and not the downtrend.
And then industrial real estate is the next one. Now, in many cases, industrial real estate has actually done pretty well, particularly, for example, warehouses that are being used to ship packages. Are there parts of industrial real estate that make sense these days?
Yeah, actually, industrial space has been doing well for a while. And recently, industrial space has done better, in part because, like you said, warehouses are doing well, storage, manufacturing, since, the trade war and all that, people are bringing their manufacturing back on shore. So those are the areas that are really, I would say, kind of the areas to focus on. The problem with industrial properties is if you don't know what you're doing, it's a lot more complex. So you either need to invest in it through a fund or a REIT, or, find somebody who knows what they're doing, because that's the complexity, is it's a little bit more complex in the industrial side than the others. But that is where the trend is going. The trend is going on the industrial side.
I assume those would be pretty high ticket items too. You're not going to get an industrial piece of property for $10,000 or something. You need millions to make that happen, right?
Not necessarily. I've got some properties around here, 2 towns over. There's office space. I'm sorry, not office space, warehouse space. It's basically just vacant land. You could pop up a warehouse pretty cheaply, and it wouldn't cost you much at all. There are plenty of ways to do it. It just depends if you're buying something that already exists or whether you're creating it. But yeah, there are plenty of ways to look at the equation.
So another real estate related one is tax liens, where people haven't paid their property taxes and liens placed on their house and sold by the municipality. What is the advantage of doing something like that? Is this a good time to do that in a self-directed IRA?
I have to say tax liens is by far and away one of my most favorite asset classes. And here's why I love it. A tax lien is basically a lien on a property. So you think of a mortgage. A mortgage is a lien on a property. It's voluntary. You decided to take a mortgage out, so you borrowed money. A tax lien is basically money you still owe to your government. So you should have paid your property taxes, and let's say you forgot, you didn't have the money, whatever it is. Well, the government is going to assess a lien on your property, and the lien is for the amount that's owed, and then they charge based on state regulations. They have an interest rate. Now, depending on the state, could be 12, 16, 18% or higher. Every state's different in how they have this laid out. But effectively, these liens have to be paid back. And at some point, so in my state, the government just sits on it and they get there, I think it's 16%. You go to a state like Florida, they get 18%. But so many people, because they're snowbirds, so many people don't pay their taxes on time that they need the money to fund their operations. So what they'll do is they'll actually auction off these liens to other people. So they would auction off to you or me. So I would get that 18%, and I would make really good interest on my money. And the best part is they take priority over every other lien, except for an IRS lien. But everything else, it takes priority. So even if it's a $100,000 property with a $100,000 mortgage, your lien still is ahead of that, so you get paid back first. So tax liens from a risk-reward standpoint are always top of the heap for me. I love them. The downside of it is right now there are too many people who know these things are online auctions now, so it's really easy for everyone to get involved, and that drives the yields down, so they're not as attractive. There are ways to get attractive yields in them. You just have to be a little bit more creative.
So what would be a resource for people to find out more legitimate? Because there's a lot of not so legitimate places in the tax lien space. What are some legitimate resources to help people get involved in that if they're interested?
It's really hard. There's some good books out there, although they're a little bit dated. And there's some people I know that are the tax lien lady. I know her. She's a good resource. There's a bunch of people out there that are doing it. I would say if you want to get the real information, you just go to the state. The state has all their documentation online on how to do it. And if you go direct to the municipality, they're going to pretty much give you all of the details anyway. It's much better to go direct than to go through some third party that you're getting a secondary lien. You may get a bad lien. It's much better to go direct unless you know what you're doing, in which case you can get some better deals if you kind of go on the secondaries.
One thing about a tax lien, you never know when you're going to get paid or if you're going to get your principal paid back. It could be a day, it could be a year, it could be 2 years. You don't have predictability of cash flow. Is that correct?
Correct. You don't have predictability of cash flow because the way that works is let's say you buy like $1,000 lien and you pay $1,000 and let's say it's accruing at 18% a year. Well, you're going to get 18% a year, but it might be 6 years before the lien actually gets paid off, or it could be paid off in 2 days. You don't have control over that. What you do have control over is if they don't pay you back within a certain amount of time, you can quote unquote foreclose. Well, all you really are doing is you're notifying the other lien holders that you're going to foreclose, and they will actually pay you off. So if you wanted to get paid back quicker, you could do that because effectively they're not going to let a $100,000 mortgage go for $1,000 lien. They'll just pay you off and they'll move on.
Very good. We're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Kirk Chisholm, Principal and Wealth Manager at Innovative Advisory Group, based in Lexington, Massachusetts. His website is innovativewealth.com. We'll be back after this.
From the boardroom to you, Voice America Business Network. Are you a homeowner tired of making monthly mortgage payments with little progress towards paying down your principal? Does paying off your home in 5 to 7 years without making larger or more frequent payments sound appealing? Paying off your home in full in 5 to 7 years is really possible thanks to Truth and Equity's Mortgage Equity Optimization System, a money management approach that puts your money to work for you 24/7. If you own a home with some equity, have a decent credit score, and verifiable income, you owe it to yourself to learn more about Truth and Equity's program. There's no need to replace your mortgage or refinance in many cases. The system works for new home purchases as well as current mortgages. Your home is your largest investment. Own it outright in 5 to 7 years. Call Truth and Equity 888-262-5540 or visit truthandequity.com 888-262-5540. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Kirk Chisholm, Principal and Wealth Manager at Innovative Advisory Group. His website, innovativewealth.com. Welcome back to the show, Kirk.
Thanks, Jordan.
So you actually have a list of the different alternative investments. We're not going to be able to get to all of them. Give people the link, and we also have this described in the video description of how they can find the list of these alternative investments.
Yeah, the best way to get the list is you go to innovativewealth.com/money answers. innovativewealth.com/money answers.
Very good. All right, let's go through some of these quickly. So private mortgages is the next one. How does that work?
So private mortgage is another favorite of mine. So if you think about a mortgage, right, you own a house, you have a mortgage on it, you're basically borrowing money from the bank. And right now interest rates are, let's say, 3%. You know, they vary depending on when you're talking about it and your credit rating. But private mortgage is a little different. So if you think about people in the real estate space, let's say there's a developer or somebody who's doing a fix and flip, or even an investor. They're not getting the residential real estate rates. They're not getting the 3%. They might get all of a sudden it's going to turn into the next FANG stock. It can happen, but you also have to have the expectation that this is very illiquid. You can't sell it, and you have to buy into this. So you need to do a lot of research up front because you have to assume that it's not going to get sold for 20 years.
Then there are kind of physical things like wine, coins, stamps, antique cars. Why does it make sense to hold those in a self-directed IRA?
Well, you can't actually. Some of the restrictions in self-directed IRAs is you can't own S corps, you cannot own collectibles, and you can't own life insurance. So things like wine, you can't own wine. You might be able to own a wine company, but you can't own wine. So there's a lot of caveats in here that you have to kind of like think through. But I know people that invest in wine, not in an IRA, but they are professional investors and they know wine very well. Or artwork is another one. Some people might know well. You just have to understand whether it can be held in an IRA, because a lot of these quote unquote collectibles can't, but there might be ways to do it depending on how it's structured.
So we have about 2 minutes to go. Why don't you kind of sum up why people should do a self-directed IRA for alternative investments as opposed to the traditional route of just stocks, bonds, and funds?
Yeah, I think it's really important that people just understand that they can. It's important that people are thinking outside the box. I mean, look, the market right now is extremely overvalued, I think, by almost any measure. And you could argue that point, but the reality is most people are afraid that the stock market is pretty much peaking, or at least getting into like a 1999 kind of scenario where it goes up a lot and then it just crashes. I think we're all kind of waiting for that to happen. A lot of the professionals are, but at some point there'll be a correction, and a lot of people are looking for options outside of the stock market. And self-directed IRAs are one way to invest outside the market. It's always best to invest in what you know, and if you don't have anything you know, find a professional that does have an expertise in these areas so they can help guide you. Because if you have the philosophy of what I call the buy and hope strategy, you buy a mutual fund or you buy a stock and you hope it goes up, that's not a strategy. Hope is not a strategy. Find an investment that makes sense for you, whether it's an alternative or traditional. We're unbiased. We don't look at one versus the other as being better or worse. We just think that a good investment is a good investment.
Very good. Well, thanks so much. My guest this hour has been Kirk Chisholm. He's a principal and wealth manager at Innovative Advisory Group based in Lexington, Massachusetts. You can find out more at his website, innovativewealth.com, and he's got a list of the alternative investments at innovativewealth.com/money answers. Thanks so much for being a great show on the Money Answer, a great guest on the Money Answer Show, Kirk.
Thanks for having me on, Jordan.
Thanks again. We'll be back next week with another edition of the Money Answer Show. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.money, 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 www.